On Tuesday, Scott Bessent stood at a podium in Washington and quietly confirmed what the smart money has been positioning for since the spring. The United States Treasury is now actively coordinating with foreign central banks to absorb long-duration debt, while the Federal Reserve, under Chairman Walsh, runs the economy hot. Stablecoin issuance just crossed levels nobody on CNBC is talking about. The dollar is weakening on purpose. And the Clarity Act, the single piece of legislation that XRP holders have been waiting on for nearly 5 years, is now sitting one signature away from becoming the law of the land. And yet, XRP is trading sideways. Bitcoin just had another shakeout. The headlines are screaming, the bull market is dead. Retail is exhausted. Forums are quiet. The mood is grim. Here's the question nobody on financial television is asking. Why are the most coordinated macro moves in 15 years happening at the exact moment retail conviction is at its weakest? Because that is not a coincidence. That is the design. And what I am about to walk you through is the precise mechanism, the plumbing, the math, the timeline, that explains why the next 90 days are going to look nothing like the last 90. The signal is in front of you. Almost nobody is reading it correctly. Welcome back. If this is your first time here, who refuses to chase candles? I read the structure underneath the price. Today, we are decoding the Raoul Pal liquidity thesis, the Walsh Fed pivot, the grand bargain unfolding between Washington and Beijing, and exactly where XRP fits inside all of it. No hype, no moonboy fantasy, just the system laid bare. Let's go under the surface. Let's start with the hard truth. 95% of retail investors are staring at the wrong chart. They are watching XRP's 4-hour candle. They are watching Bitcoin dominance. They are watching the Coinbase app. The people who actually move this market are not looking at any of that. They are looking at one thing, the global liquidity curve, and that curve has just inflected. Here is the mechanism most people do not understand. The United States is sitting on roughly $37 trillion of debt. A significant portion of that needs to be refinanced inside the next 18 months. The Treasury cannot let yields spike, because if yields spike, the interest expense on the national debt alone consumes the entire defense budget. So the Treasury has exactly two options. Option 1, force the Fed to monetize the debt directly, which destroys the dollar's reserve status. Option 2, engineer a system where foreign capital, stablecoin issuers, and a controlled weakening of the dollar absorb the long end of the curve, while productivity gains from artificial intelligence absorb the inflation. Option 2 is the path. And it is the path that has been chosen. This is what Raoul Pal calls the everything code, the funneling of energy into intelligence, and intelligence into financial restructuring. Walsh at the Fed is the Greenspan appointment of this era. He is a technology accelerationist. He is a crypto-native investor. He understands that the only way out of the sovereign debt spiral is to inflate the asset base, while productivity quietly suppresses the consumer price index. And here is the part the retail crowd is missing entirely. Stablecoins are not a sideshow. Stablecoins are the financing mechanism. Every dollar of Tether, every dollar of Circle, every new dollar of bank-issued stablecoin that enters the system is forced to buy short-duration treasury bills. That is the law now. The Genius Act made it the law. Stablecoin issuance has become the single largest marginal buyer of short-end U.S. debt on the planet, which means, and this is the part you need to internalize, the more crypto adoption grows, the more it finances the United States government. Crypto is not the enemy of the dollar system anymore. Crypto is the rescue mission for the dollar system. And the entire regulatory apparatus in Washington has just figured that out. Now ask yourself, in a world where stablecoin rails are the new financing layer of the United States Treasury, which settlement asset, which neutral bridge currency, which on-demand liquidity layer is positioned to handle the cross-border, interbank, multi-currency clearing function? It is not Bitcoin. Bitcoin is the digital gold reserve. It sits on balance sheets. It does not move. The settlement layer is XRP. That is what it was built for. That is what Ripple has spent 13 years quietly constructing the legal, technical, and political infrastructure to enable. And it is finally being switched on. Let's do the math. This is the math the retail crowd refuses to do because the numbers sound absurd until you actually run them. The global cross-border payment market moves roughly $150 trillion annually. The foreign exchange market clears $7.5 trillion per day. The global derivatives market, by notional value, is over $1 quadrillion. Nostro vostro accounts, the pre-funded liquidity that sits idle in correspondent banks to facilitate cross-border settlement, hold approximately $27 trillion of trapped capital at any given moment. XRP's fixed supply is 100 billion tokens. Approximately 55 billion are in circulation. The rest are locked in escrow, released at a rate of 1 billion per month, with the vast majority of each release immediately relocked. Now here is the calculation that breaks people's brains. If XRP captures even 0.5% of the cross-border payment market, not the derivatives market, not Forex, just cross-border payments, that is $750 billion of annual settlement volume flowing through a 55 billion token float. Run the velocity math. A bridge asset does not need to be held. It needs to be touched. But every time it is touched, it needs to be priced at a level that allows the transfer to occur without catastrophic slippage. If a bank needs to move $100 million from US dollars to Philippine pesos, and XRP is priced at $2, that single transfer requires 50 million tokens. At $20, it requires 5 million. At $200, it requires 500,000. The higher the price, the more efficient the bridge becomes, which means the system is not just permissive of a higher XRP price. The system is mathematically dependent on a higher XRP price to function at institutional scale. This is not a prediction. This is a design requirement. Now layer in the supply side. Exchange reserves of XRP are at multi-year lows. On-chain forensic analysts at Glassnode and CryptoQuant have been tracking a consistent outflow pattern from exchanges into long-term holder wallets and institutional custody addresses for the past 9 months. Tokens that move into a multi-signature institutional vault do not come back to market for a 10% profit. They are gone, removed from float, permanently, 55 billion circulating, a growing percentage locked away, a demand curve about to be hit by stablecoin-driven cross-border settlement volume measured in the trillions. If you have a problem with these numbers, you do not have a problem with me. You have a problem with arithmetic. While retail investors are panic selling because of a 4-hour candle, the institutional signal has never been louder. Ripple's acquisition of Hidden Road was not a press release. It was a declaration. Hidden Road clears over $3 trillion annually across foreign exchange, fixed income, and derivatives. Ripple did not buy a payments company. Ripple bought a prime broker. They bought the infrastructure that institutional capital uses to move size. Does a company position itself as a prime brokerage for cross-asset clearing because they expect XRP to stay at $2? Ask yourself that question and answer it honestly. The G Treasury acquisition gives Ripple direct access to over 10,000 corporate treasury departments. That is not a retail play. That is enterprise treasury management. That is Fortune 500 finance teams using XRP rails for liquidity optimization. Spot XRP exchange-traded funds are now live. Inflows have been consistently positive. BlackRock, Fidelity, and Franklin Templeton are not gambling. Larry Fink does not allocate balance sheet to assets without absolute legal certainty. They do not chase, they position. Japan's Financial Services Agency has formally cleared XRP for institutional use. South Korea is following. The UAE has been given dollar swap lines as part of the broader grand bargain Raoul Pal described, and the UAE's sovereign wealth funds have been quietly accumulating digital assets for over 2 years. Then there is the Clarity Act. This is the legislation that retroactively removes the regulatory ambiguity that has kept the largest American banks on the sidelines. The moment this becomes law, and it is now a question of weeks, not months, JP Morgan, Citi, Bank of America, and Wells Fargo can hold, custody, and transact in digital assets without the SEC sword hanging over them. The risk premium that has been suppressing the entire market vanishes overnight. This is not retail FOMO. This is calculated multi-year positioning by the largest custodians on the planet, who have access to information you and I will never see. If you have made it this far, you are already separating yourself from 99% of the people in this market. Take 3 seconds, hit the like button, and subscribe if you have not already. It costs you nothing, and it tells the algorithm to push this analysis to the people who actually need to see it before the window closes. Comment the word structure below, so I know who is paying attention. Back to it. Here is the calendar. Memorize it. June through August 2026. The Trump administration, the Treasury, and the Federal Reserve have a finite political window to lock in the macro restructuring before the midterm campaign begins consuming all oxygen. The Clarity Act needs to be signed. The grand bargain with China needs to be framed. The dollar needs to be weakened in a controlled fashion. Stablecoin legislation needs to be fully operationalized. Walsh needs to telegraph the rate-cutting cycle. September 2026, the Federal Reserve's policy meeting. This is where the first decisive rate cut of the new Walsh era is most likely to land. Liquidity floods in. October 2026. Historically, the bottoming month for risk assets in a 4-year cycle. Raoul Pal's liquidity model points to this window as the inflection. My own read is that this is where the final retail capitulation occurs, the moment of maximum despair, immediately preceding the parabolic move. November 2026 through Q1 2027. The midterm elections complete. The political calculus that has been suppressing institutional flows resolves. Stablecoin volumes, having absorbed the short end of the curve all summer, begin to demand a settlement layer. ETF flows accelerate. The Clarity Act, now law, removes the final legal gate. This is the window, 3 to 6 months. After that, the price you see today is a memory. The wait-and-see money becomes all-in money the moment the regulatory fog clears. And institutional money does not buy in installments. It buys in blocks. We are moving from an era of abundance to an era of scarcity. And almost nobody has noticed. Exchange reserves of XRP have been quietly draining for over a year. Every monthly escrow release from Ripple is being met with relocking, OTC distribution to institutional buyers, and direct allocation to enterprise customers. The token is not flooding the market. The token is being siphoned out of the market. Once a token enters a BNY Mellon custody vault, or a Coinbase custody multi-signature wallet held on behalf of a sovereign wealth fund, or a Fidelity Digital Assets cold storage allocation, it does not come back. Not for a 10% gain, not for a 50% gain. It is institutional inventory. It is balance sheet. It is held for a function, not for a trade. This is the great inversion that retail does not see coming. For 13 years, retail has been the dominant holder of XRP. The price has been set at the margin by retail panic and retail euphoria. That era is ending. The marginal buyer is now an institution. The marginal seller is increasingly nobody, because institutions do not sell. When the final regulatory switch flips, the order book on the buy side will look nothing like what you are used to. The bids will be deeper, the asks will be thinner, the volatility profile will compress on the downside and explode on the upside. And the retail investors who spent 3 years complaining on Twitter about Ripple, about the SEC, about price suppression, those investors will become the exit liquidity for the institutional accumulation that has been happening right in front of their eyes. The institutions have spent years trying to shake you out so they could take your position. Every red candle was a discount they were happy to absorb. Every wave of FUD was psychological warfare designed to transfer tokens from weak hands to strong ones. The door is closing, The window is narrowing, and once it closes, the retail investor who hesitated will not be priced out by a few percent. They will be priced out by an order of magnitude. I know it is hard. I know watching the chart bleed sideways for months is exhausting. I know the headlines about Middle East tensions, about Iran nuclear negotiations stalling, about midterm uncertainty. I know all of it weighs on conviction. But here is what an analyst is trained to do. Distinguish noise from signal. The noise is the 4-hour candle. The noise is the influencer telling you the cycle is dead. The noise is the YouTube comment section panicking because Bitcoin dipped 6% overnight. The signal is the Clarity Act. The signal is Hidden Road. The signal is Walsh at the Fed. The signal is stablecoin issuance becoming the marginal buyer of U.S. Treasury bills. The signal is exchange reserves at multi-year lows. The signal is BlackRock filing for a spot XRP ETF, and that ETF taking in money quietly, day after day, while nobody is watching. Being early feels exactly like being wrong, right up until the moment reality catches up, and then it feels like genius. The question is not whether the price will recover. The question is, who will still be holding when the new floor is the old ceiling? The question is, who will be patient enough, rational enough, and disciplined enough to ignore the noise for 90 more days? The masses are watching the candles. The smart money is watching the structure. Choose which side of that line you want to be on. Let me leave you with this. Price is a distraction. Structure is the reality. Bitcoin is the bubble that gets the headlines. XRP is the bridge that does the work. One is a store, the other is a system. The summer of 2026 is the setup. The fall of 2026 is the inflection. The winter of 2026 into the spring of 2027 is the resolution. By the time the average investor figures out what happened, the chart will have already done the work the math has been demanding for years. You are watching a sovereign debt crisis being solved with crypto rails in real time. You are watching the largest financial institutions on the planet quietly position themselves on the correct side of a legal framework that has not even been signed yet. You are watching the slow, deliberate, methodical transfer of an asset from the impatient to the informed. History does not reward comfort. It rewards those who pay attention when the room is quiet, and right now the room is very, very quiet. Comment structure below if you made it to the end. I want to see who actually understood this. Hit subscribe if you value this kind of deep work. Share it with one person who needs to hear it before October. Stay patient. Stay rational. The math does not lie, and the system is almost complete.